So let's take a look at why averages can be so misleading, and when we are doing all of this computation using averages, why we may not get an accurate answer. So we have two portfolios. Portfolio 1 is 14% average return, and portfolio 2 is 10% average return. Which portfolio will you choose? Because this is a trick question, so we are double thinking, but most people would choose portfolio 1 with the higher average return. And if you do a basic math, it looks that portfolio 1 with a higher average return actually ends 35% lower than portfolio 2. And this is because averages, it hides volatility. When we look at an average yearly return number, we have absolutely no idea of what is the kind of volatility that average encompasses. So it can be very, very misleading. That's the first lesson to be careful of when we're using averages. Second, even if we look at two portfolios with the same average return, but the sequence of the return is different. So let's look at portfolio 1. That earns 20, 25, 25, 5, and minus 15%. Let's look at portfolio 2. Portfolio 2 is simply the inverse of portfolio 1. So the return that portfolio 2 earns is in the reverse order that portfolio 1 earns. Both of them averages 12%, and you can see that both portfolios, because of the difference in which those returns were earned, actually ends with different terminal values. So averages hide sequence. This is a big problem. They hide volatility, they hide sequence as well. Now, why should we bother? Big deal. This may be of interest to math professors, but does this really make a big difference to us as planners, or does it really make a big difference to investors? So let's take a story. Let's see how this can impact retirement planning. So the year is 1996. This is a fictional story. If there are Shalinis and Mayas in the audience, my apologies. The data is actual, but the story is entirely fictional. So let's talk first about Shalini. So she's an individual who's been working throughout her career. It's the year 1996, so we are rewinding back. And she's 60 now at 1996, and she's looking forward to a comfortable retirement. She was a very disciplined saver. She has accumulated a retirement corpus of 1 crore, which is fantastic because we're talking about the year 1996. She has the typical employees' provident fund, public provident fund, but she's also been a prolific investor in stocks and mutual funds. And if you look at the CAGR of equity between 1980 to 1990, that made her a lot of money. So she now wants to retire, and she rings up her trusted advisor, Maya, to ask to do some math. How much can I withdraw from my retirement corpus? So this is the analysis that Maya does for Shalini. So Shalini's current age is 60, life expectancy is 90. She assumes an equity return of 11%, which is very conservative because we are talking about the year 1996. So when Maya was drafting Shalini's plan, equities were giving much better returns. So if you look at the CAGR, we're talking about 15 to 20% CAGR. But as a careful planner, Maya is being conservative. She doesn't want to be aggressive, so she takes a lower equity return of 11%. She assumes a debt return of only 7%, right? Which is again very conservative because the Indian economy was a high inflation economy in the 1980s and 1990s. And nominal interest rates used to be in double digits. But she assumes a lower return. She assumes an asset allocation of 70% to equity, 30% to debt. It's an aggressive allocation based on Shalini's profile. And she calculates a monthly pension of 50,000, which can be increased by 6% each year. The way she arrives at this is exactly the way we looked at retirement computation in one of the previous slides, in which we are factoring in an adjusted rate and calculating how much income can be drawn. So this is a graph. So this is a time scale. So let's look at how things panned out for Shalini. This is the pink line. That is the expectation. So when Maya drew her financial plan, this was the expectation. Initially, the retirement corpus increases in value. And that's because in the initial years of your retirement, the expenditure, the withdrawals that you are doing from the corpus is lower than the income that the portfolio earns. So even though Shalini is drawing a pension from a retirement corpus, for many years that retirement corpus keeps going higher. But there comes an inflection point where the expenses start outstripping the income. And that's where the retirement corpus falls. But it's not supposed to go to zero before 2026, which is when Shalini turns 90. This is the reality. So in the initial years, you can see how the portfolio is going up and down, and that's very natural because equity is volatile and her retirement assets has equity. But even with those volatility, the retirement corpus value was broadly keeping in line with the expected outcome. But across the period 2000, which is when the dot-com crash happened and the markets went into a tizzy, you see the retirement corpus falling significantly. By 2002, it had fallen quite a bit against the expected value. And this is where, as planners, we wear our behavioral hat. After having done the math, we tell the client that equity is a volatile asset class. You have to hang in, don't worry, markets will recover and your retirement corpus will again go back to its expected value. And Maya tells this to Shalini, and that is exactly what happens, right? In the bull market of 2003 to 2007, 2008, you can see how the retirement corpus has actually recuperated so well. By 2007, actually the portfolio has come back to its expected value, right? And Shalini is very happy, Maya is happy as well. But then comes the global financial crisis, and then the market tanks again, and hence the retirement corpus also tanks. A similar conversation is done. Maya again tells Shalini that things will get better. Equity is a volatile asset class. But her retirement portfolio never recovers. You can see it exhausts itself at 2016, which is a full 10 years before it was supposed to exhaust. So at the age of 80, when financial security is the least concern, that should have been the least concern of Shalini, she's left with the prospect of staring at a lower retirement corpus. So this is why factoring sequence of return, factoring volatility in retirement planning is so important. Now what went wrong? If we look at the return projections, Maya, you cannot fault the planner for getting her return assumptions wrong. So Maya had projected that equity will return 11%, and in fact between 1996 and 2016, the actual equity return had indeed been 11%. So she was absolutely spot on in projecting a return of 11% on equity. Maya had also assumed a debt return of 7%. The actual debt return that Shalini's portfolio had earned from 1996 to 2016 was close to 9.5%. So debt portfolio actually significantly did better than projected. So you really cannot fault assumptions, and the culprit, as is very clear, is volatility and sequence of return.